Good morning, all. Steve Parisi here with IBC Global. I hope your day is off to a great start as usual. For today, we've got a special guest, Justin Canberra, who is involved in all things real estate, and he works for one of the largest companies in the world. Justin, how are you this morning?
Good morning, Steve. Thanks for having me on. I am fantastic. It's bright and early over here in Seattle. Looking forward to having this.
Right on. We're going to have some fun. So over in Seattle, is it raining today?
One of the few days it seems like where it isn't raining. It is on the colder side, but it is bright and sunny this morning. So life is good over here.
Very nice. Always good to hear. Well, thanks so much for making some time. So I know we started at 10 a.m. Eastern, which is 7 a.m. your time, and you're in the office, so that means you were up bright and early today to get in. But just talking before, you're an early riser. But I appreciate you making some time today. I do. Well, what I want to talk about today is cash value life insurance, like we always do, but more so on the real estate side. As when we first connected, your background was and has been for a long time real estate investing, correct?
Exactly. Yeah, I started about 2016. I did my first real estate deal, which is a house hack where I live into the top unit and I rent the bottom out. So a
Gotcha.
little over 5 years been investing in real estate.
Got it. Very nice. So we can get into the details on that, but let's start. So you're involved in real estate investing, and the company you work for, so one of the largest companies in the world that I talk a lot about in our videos because I admire their business model, Amazon. Mhm.
Exactly.
What's your specific role at Amazon?
Yeah. So, I was talking about I got into real estate in 2016, and after a couple of years, I was like, man, I really like doing this real estate stuff. Why don't I figure out how to get paid at work to do real estate? And the beauty of working for a large company is that there's a lot of roles, a lot of groups. Just so happens there's actually multiple real estate groups within Amazon. The first two were I didn't end up getting. The third one, I actually used to work in the group within the finance area. And so I knew a lot about this organization already. And so there's a little bit an easier transition for me to get into a real estate focused role. So my current role is what's called a senior expansion manager in real estate. And so the specific group's called Global Specialty Fulfillment. And so if you need it fast, if it's a heavy, bulky, chilled or frozen or picking it up, those buildings, I'm part of the search of it. So finding the right one that make financial sense for us to secure and use for our operations.
Got it. And with that role, so Amazon was able to leverage your prior background from real estate investing, and that's kind of what helped you acquire that role at Amazon.
Exactly. It's the mindset that I learned just by doing externally, but then being at Amazon, knowing the Amazon leadership principles, having the Amazon finance background, you merge all that together. It's like a perfect medley of what you need for this specific role.
Yeah, definitely. So I've got a question. So Amazon, they've got a lot of cash, which that's public knowledge. They do well as a company. So when they're searching for buildings, properties, and you're involved in that decision-making process, finding it, assessing it, I'd assume, I don't know if you get into the negotiation and such. What's that process look like? Like, will you help assess the value to say, hey, here's the fair market value based on surrounding properties and such? Is it similar to what you do individually? If you want to walk through that process a little bit, I'm curious.
Yeah, so in the real estate part, you can almost kind of break it up in two parts. We have a group that's very transactional in nature, working with the brokers and looking at what's in the market, surveying. I'm more on the internal side. So, what I like to say is a real estate consultant for the business. So, I'm analyzing all the properties, figuring out which one makes the most sense from a capacity, cash flow, payback, financials perspective, and then making the recommendation to the business, getting their alignment. And then once we're aligned, then at the end of the day, we still got to go to finance and get the paycheck, get the money, get the building, get the lease signed. And then we, once the lease is signed, we turn it over to our pre-construction, construction, startup, and launch teams to then get it all the way to launching the operations.
Wow, that's a process. So it sounds like your primary role there is a lot of the internal analysis, like you mentioned, the cash flow and such, to make sure that if Amazon decides to purchase the property, that the returns, just like you or I would look at an individual property, will I be cash flow positive? Is it worth me purchasing this property? They're doing the exact same thing.
Exactly. Yep. We're,
Got
just like in day one, where it's about long-term cash flow. So we're looking at where our customers are at, what kind of operations we want, what's the volume going to be. Based on those metrics, there's a specific building type that we're looking for that'll work, that we can, main thing is focusing on the customer and delivering the product and service, but doing it at a cost structure that works for us.
Gotcha. That's cool. So to kind of segue then into your personal real estate portfolio. So if you're doing it for the best, right? The best at the Amazon, they're the best in many areas. I would bet that what you've learned there, so you've been doing real estate before you've worked at Amazon, but what you've learned there, taking that knowledge and experience into your own practice has helped really give you, call it, an edge against competition if you're viewing it that way.
Yeah, I get definitely a lot of transaction volume. So like,
I bet.
it's kind of funny because personally I deal with thousands of dollars, and then obviously at work it's hundreds of thousands, or really in millions. So
Yeah.
I'm doing probably a little bit over $1 billion a year on the Amazon side, but I'm doing hundreds of thousands, maybe a couple million a year personally. So it's like two different dollar amounts, but fundamentally it's the same thing.
Yeah.
It's understanding the financials, making good business sense of where to put your cash at so that you can get return on that capital.
Got it. Very nice. So with your personal real estate portfolio, so you've been involved in real estate since 2016,
Correct.
personally? Gotcha. What's your portfolio look like now, just from a property size standpoint?
Yeah, so let's see, I just bought my largest deal in January, so last month, January 2022, which was a 16 unit. So after that, it brought me up to 85 units,
Nice
which would
work.
be 85 rental units, and then 32 properties. I got a triplex closing next month, and then I'll have another two properties I should be under contract this month. So very quickly scaling up. Should be, I'm thinking breaking 100 units by the end of this year.
Gotcha. Nice work. Do you have a long-term goal just with respect to property size, like how many units or properties you'd like?
Not really like, thinking big, like I want to make this like massive. So like, I'd love to have like $1 billion, like as total assets. Obviously, I'm a long way away,
Yeah.
but like mentally, I'm trying to trick myself to think it's not that far away. Because like one thing I've been thinking a lot lately is like $1 billion is just 1,000 million.
Yeah.
So I've already got a couple million. So it's just continue to stack the millions. It'll become $1 billion. So
Mhm.
and it's very exponential, and it's kind of like cash by life insurance, where there's initial investment and it builds over time, and it starts really building the longer you're in the game. And so that's what I'm starting to see. So even though it's still far away, it's possible.
Yeah, yeah, definitely. And I like that. It's just one at a time, 1 million at a time. That's the only way you can look at it. When it comes to business building, like everybody's always looking for the home run, the shortcut. How I look at it is like, hey, just take a deep breath, step back, and stick to the fundamentals. And if you want to use a sports analogy, look at Tom Brady. Just same thing over and over again. When a home run opportunity comes around, he takes it, but for the most part, it's just those 5 to 7 yard passes, and he moves down the field and he scores.
Exactly.
Yeah, that's it. So let me ask this, just for listeners: how old are you?
I'm going to be 43 this year.
43. So you look a lot younger.
Yep.
Compliment. So you started in 2016. So that's about 6 years. So that means you started 37, getting in real
Yep.
estate. Nice. And you've built it to 85 units thus far. So keep it up. Nice work with that.
Thank you.
Certainly.
Yeah, it starts with one, and this is what I tell other people that I'm helping out that are trying to get into the game, is that you get your first one that takes a while and then uses a lot of your capital. But the second one, the third one, they start coming shorter and shorter, to where like, a lot of times I'm averaging a deal like every month, every other month, to continue. Now, I'm buying smaller deals in the Midwest so you can continue to stack them. But if you could buy bigger deals, still over time, as you start getting the experience, and you potentially get partnerships and you're getting appreciation and moving the money around, you're able to get by faster
Yeah.
over time.
Yeah, definitely. And when you purchase property now, so in the beginning, I'd imagine you would go to each property, look at it individually. You knew what to look for. I'd assume now, just with experience, you know exactly what to look for to assess a property. What's the value? How much can I make on that? Do you still do that with each property you look at?
Yeah, so the ones that are in state, yes, just because because I can physically drive there. The ones that are out of state, I don't always go look at them. Now that I have a team of inspectors and property
Nice.
managers and agents and stuff, like the one that I'm buying next month, like physically we haven't seen it
Hmm.
and gonna buy it. And this one I actually own with a partner. But what ends up happening is it becomes very expensive, and so like I used to fly out to Milwaukee, so it'd be about $1,000 round trip. Got your flight, your food, your hotel, your rental car, and then I used to buy like a T-shirt every time I was in town. And then after about 5 of them, I was like, well, this is getting expensive. Maybe we should, figure out how to scale this without spending $1,000 every time.
Hmm. Gotcha. Nice. Yeah, and that adds up quickly. So let me ask this. 2016, you got involved in real estate. When did you discover whole life insurance and high cash value life insurance?
I think my first one I want to say it was in 2018 when I got my policy. But, when you get into the real estate sphere,
Yeah.
there's a lot of, it's all about networking. And whether that's actually, back in the day, it used to be in-person networking. Now it's a lot more virtual, but then there's a lot of like within YouTube sphere and Facebook groups, there's a lot of these people are always trying to figure out like, how do you accelerate the game? And what do you do with your cash management? And so I started hearing about this cash value life insurance, and I got more and more interested into it. And then I just started watching tons of YouTube TV. Hence, that's how I ended up stumbling across you.
Gotcha. Gotcha. And you had, so 2018 you discovered it, which was before we really started YouTube. I was in the business back then, but doing no marketing. I didn't know anything about marketing. I still don't. I learn as I go, to be frank. Um, but I've got a question. So on the cash value life insurance, so you discovered that through real estate. Just I'd imagine other real estate investors talking about whole life insurance, how they use their policies, and said, okay, I want to understand this further and see if it's a fit for me. Was that kind of the beginning?
Exactly. And I was listening to a guy who had a podcast. He would interview a lot of real estate people, but then he was also an agent and would sell, infinite banking type
Got it.
policies. And so the more that I got the education, not just from him, but as guests, and I was seeing how they're using it, I was like, man, this seems like something I need to get into. And so I spent probably at least a year getting into it. And maybe I got into it in 18, and maybe I think I funded it actually in January of 2019 because
Okay.
I did my fourth installment payment of it. So, but yeah, it just took me a while to get used to it, because there's the what you always talk about, the base premium out of the gate is that big hit, but it's the long game, and which is real estate is the same thing. It's about the long game. So then I was like, all right, this sounds good. The more I started getting into it, originally I was going to do 10,000. I was like, maybe 25. And then I was like, how do I put as much as I can do?
Yeah.
And so then I did 50,000 on my first policy when I got in.
Yeah, got it. Nice. So when you looked at that first policy, you mentioned you took a lot of time, close to a year, just digging into it. And you mentioned the first year too, kind of the main objection or the pain point where I pay money in and I don't have all of it. And that hit up front, especially for a real estate investor, where you think, I can use that lost capital for a real estate deal and accelerate the returns and move faster. That's like a key objection that comes up. And I get it. Like that's what we like to look at to make sure someone's comfortable with the product. So when you dug into it, what objections popped up? Like what I want to hit on here, or were there any things during your research that you learned that you did not like? And even after you've had it for a while, say, okay, I love the idea that it's a safe, liquid, tax-free area to position money, but what are some things that you say, man, if I would have known this first, that would have helped me just with my overall decision-making process and using it, call it a learning experience as the years have passed, you know?
Yeah, and a lot of it is so I did the YouTube stuff, and then I read the Nelson Nash book as well, Becoming Your Own Banker. That was a great tool as well. As I started getting into it, I talked to a few other people, looked at different policies. Um, I obviously know more now, and a lot of it's from your IBC Global channel, because at the time, like there wasn't a whole lot of people that did the 1090, and the first one I did was actually it ended up being a 3070. And if I knew about the 1090 out of the gate, I would have done that. Because you like show the policies over time, like 1090 tends to do the best. So that would be the one thing. And then the other thing that I really didn't kind of figure out until later was that when you set it up, like how long is it going to be? Because when you're doing these lower base premiums, you got to have like the rider on it, and so understanding like the mech and how long you can go. Because originally I thought I had signed up for like I could do this 50,000 a year, but I think my first one is only like a 10-year period, and then it's I think it's called a reduced paid up premium or something like that.
Got it. Is that what the first policy, the 3070 design?
Correct. Yeah, the first one's with Penn Mutual. My other three are with Mass Mutual.
Got it. Got it. Yeah. And on that point too, without getting to the weeds here, because I talk too much about policy design and I'm aware of it, is when you look at different splits and the whole mech issue, you can take a 3070, a 1090, or any type of design, and the mech risk is often the same from one design to another. The total death benefit and individual's age, but really the total death benefit is the main indicator of what that mech limit will be during the first 7 years, and then every 7 pay test after the first 7 years. So yeah, there's often a lot of conversation around, hey, will a policy mech with a lower base premium and such? And the answer is no. If it's properly mech tested, like with that Penn policy, we can look at it. There's probably a chance that you can continue to fund it beyond the 10th year, depending on the initial design and what that death benefit was set at. Might have to lower the payment a little bit. Maybe it's not the same 50K, but you can still pump money into it if you wanted to.
Oh, nice.
Yeah.
Yeah, I mean once you get into that inflection point where $1 goes in and more than $1 of value is in there, that's really the beauty. And I thought I was going to get there faster with the pen, but it's like just this year is kind of the like almost the break even, and so it's like, how do you compress that down? And so these other policies that I set up, I'm in year 2 on these Mass Mutuals, and I'm looking forward to seeing that happen faster, meaning every dollar I put in, then it gets greater than $1. Ultimately, then that's the beauty of the whole game.
It is, yeah, just maximizing that cash value growth. And what you touched on there too is probably the number one thing I hear from real estate investors. Like they look at the asset and say, okay, this is a great area to store cash. The net growth rate, the internal rate of return will fall somewhere between 3 to 5% at the end of the day. Like that's what it will do, even though the projections show different numbers depending on the carriers. But the number one thing that comes up, and I've seen this with real estate investors and business owners that are pumping 6 figures plus into products, is that upfront cash value. Because I've noticed, even if they don't use it, that's the opportunity cost. And they say, I've built my net worth, whether it's real estate or my business, through cash, having money available upfront, and I do not want to give that up. So
Right.
how do I maximize the upfront value? I've seen more value put there by a lot of people than the long term, or similar value, I should say. But long term, there's never really a huge difference when you look at it. It's just how do I maximize the upfront so I have access to it. But
Exactly.
yeah,
That was as I was doing the second round of them, I was like, how do I minimize that first year hit?
yeah,
And that was then moving close basically the 1090, right?
yeah.
And that was the biggest benefit of going to that.
Yeah, when you look at copying corporations and banks and what the ultra wealthy do, like that is it. When you look at products like bank-owned life insurance is a bit different than what you and I can acquire as an individual policy. They've got positive cash value in the first year, but it is a cash-rich policy. When you look at corporations, they're always minimizing the base premium. When I worked at that firm where we designed policies for corporations, how low can I go with that base premium and just juice the cash value? Like that was the name of the game, because it was an asset on their balance sheet. And if they took a negative hit, that impacts their profit and loss statement up front, which they're like, we don't want that. We want the cash up front. We don't even plan on using it. We just want to see it there. So that often comes up quite a bit. Let's segue a little bit into how you use the policies, if you'd like, for real estate.
Perfect. Yeah, I've used it quite a few times for real estate. And so like the first time that I used it, it's like so when you fund the policy, then you have the cash value. And just like what is talked about on your podcast and YouTube stuff, is that the access to this money is actually pretty fast.
Yeah.
Like it seemed like a couple weeks. I was, after you take the base premium out of it, you're able to access that money. So what I was doing was then I put the money in there, it shows up as cash value. I do a withdrawal. I then go pump that into some real estate investment. And then as that real estate investment's making money, then I push it back into the policy. And so I'm trying to take that, because when I take the money out, now I have that loan and I'm paying interest on it. So now I'm trying to take the money from the asset I bought and pay off the loan that's in the policy. So that's more of my long-term play. I've done also a shorter term play as well, where I bought a property in Milwaukee and I'm doing what is for real estate investors. There's this acronym called BRRRR. So it's buy, rent, or buy, rehab, rent, refinance, and repeat. So basically I bought this property that needed to be fixed up. So I bought it, I think it was like 85,000. I put like 40,000 into it. And then I put a tenant in there that's paying rent. And then I went to the bank and said, hey, I bought this property, added value to it, got a renter in here. What can I get out of the property? I do a cash out refi. In a perfect world, I would have got 100% of my money back out and I put it back in the policy. In this one, I ended up leaving, I think it was maybe about 10% of that. So like I had taken all the money out for the purchase, for the rehab, and I was able to put roughly 90% of that money back in. And then as I'm getting money from the property on a monthly basis, I can put it back in to pay that policy. So it's kind of like a gas tank, where I'm pulling it out, putting the money back in, but it's really my growth engine for me to drive my real estate business.
Yeah, kind of like a personal line of credit that you've got access to and complete control, nothing that the bank can call like a line of credit against a piece of property or anything like that.
100%. And that was like one of the biggest things for me, is like, as I'm, my goal is to go full-time real estate. To do that, you need liquidity, you need runway, so that as you are building out your own business and you move away from the steady paycheck, you've got cash to continue to drive the business. And so that was my main thing with it. And as I look at, the state of the economy that it is in today, like I'm even like, as I do like cash out refinances on properties, instead of holding that into a checking account, I'm moving all that into my policy. Like I'm pulling out a 3.5% cash out refi, sitting in my policy that's going to be north of that, slightly north of it. So, but I'm able to control this 100%. Anything in my policy, anytime I want, in and out on my own.
The control factor is key. Yeah. How I look at it really on the same topic as the personal line of credit is the policy produces, let's call it 4%, the net internal rate of return. Eventually, in the early years, we're negative. I like where you said that if you're going to borrow against your HELOC at 3.5% and put it into your policy, initially you would have a negative hit there in the early years, because the policy will not be earning 3.5%. And awareness is key. I know you and I talked about that, I think it was a week or two ago. But just awareness there, because where people get upset is like, wait a minute, I thought I was earning more, just because it can be confusing. But we don't have to get into detail on that. So for me to get back on track, if I've got that personal line of credit where I'm producing, call it 4%, if that's my average IRR, which is a tax-free IRR as well if I don't mech it out, now you can borrow against that. Right at 3%, 3.5%. Well, you can do that with a collateral loan. With a policy loan, it's a bit higher. But if it is for business purposes and such, if I can capture a tax deduction there, I can put myself in a nice position where I can have a tax-free growth rate and a potential tax deductible cost to borrow.
Exactly. You get kind of the best of both worlds. And It's all about money management and where is the best spot to pull it from. Do you pull it from the policy or do you use the lines of credits? And, because when you do pull it from the policy, generally it's at 5%. So you're trying to balance that policy rate out. Now, when I'm doing these short-term projects, that's better than a lot of like what is called hard money, which is, around 10%. So like originally I was going to do hard money, and then I was like, man, look at all these costs to set up the loan. I got to pay fees for appraisals and draws and all that. And then I was like, I could save like around $5,000 if I just use the money that's in my policy. And so then that's what I ended up doing.
Gotcha. Quick and easy. Yeah, direct policy loan. I like how you put that. If you're looking at hard money, that's a good option there. And you've got the control factor. One thing I want to touch on, just for listeners, because I may have made it a little cloudy when I said it, is direct policy loans. When we're borrowing directly against our life insurance policy, you're correct. Usually it's right around 5%. Depends on when we bought the product and what company you were with. But if we're using that for business purposes, deducting the loan interest from a direct policy loan with an insurance company is difficult. I've seen some CPAs do it with their clients. However, the IRS typically does not like life insurance loan interest deducted directly against a policy. Again, some CPAs have done it. If you've got a tax advisor that does that and is confident, that's perfectly fine. I'm not giving tax advice. But the IRS, they do state they don't like it. Compared to those cash value collateral loans, which we can touch on in a little bit, that's where you can get typically a lower cost to borrow by leveraging your life insurance policy and a tax deduction because you check off on the bank's paperwork, this is a business loan. So it makes life easy and I don't have to worry about our friends at the IRS sending us any letters.
Right.
Yeah, definitely. So before we kind of segue into that, let me ask this. So you've been using your policies effectively. You've got a number of them, your Penn policy, Mass Mutual policies as well. You cash flow them with a significant dollar amount. How did you purchase real estate before using the policies, especially when you needed cash? And you may have touched on it with the hard money lending, but if we're just going to kind of paint the picture of before and after, using the policies now, but what did you do beforehand?
So at the beginning, because I do work at Amazon, we get what are called RSUs, restricted stock units. So as I was getting these grants or vested, I was selling those, and obviously Amazon's done well over the last 10 years, right? 20 years.
Yeah.
So it was going up, and I would diversify because if you live in Seattle, your income's from Amazon, the real estate's going up because of Amazon. So it's like, why don't I divest? So I was taking that and then I was buying real estate in the Midwest. So kind of diversify my portfolio. And so that's how I was buying it originally. Plus I was just, I live below my means. I still live in a 1-bedroom apartment in one of my properties. And so I don't have very much overhead. So I'm just cash flowing at work, cash flowing on the real estate, and I just stack that up and then I buy properties from there. And then more recently, I've been, instead of selling the stock, I've been doing a asset-backed loan against it. So my stock's sitting in a trade account. I then can take roughly 2/3 of that out, buy real estate, then that real estate then pays back that loan. And so it's just any access to cash, moving it around into the right thing, to one where I can control it, and two, minimize my cost of money is what I've been focused on.
Yeah, nice work with the asset-backed loan. I mean, you're leveraging stock that has done quite well. So I mean, that's gone nowhere but up really over the past 10 years. And then instead of pulling the money so you don't sacrifice the returns on it, you leveraged it basically like a life insurance policy.
Exactly.
Yeah. Very nice.
In today's world, it's perfect, right? Because there's two things that can happen. It can borrow money and then what I buy goes up and then the stock goes up. But it can go the reverse. So you have to be cognizant that the stock could go down, the thing you bought could go down. You could get a margin call over here as well because you got to meet the loan requirements. So, fortunately I've been lucky, but I'm always managing the cash flow. If I did get a margin call, I've got my policies with cash value that I could come in if I needed to.
You can use both. Yeah, just well diversified. Yeah, and that's the best way to go, in my opinion. I always see financial professionals and insurance agents fight with each other to say one way is better than the other. But at the end of the day, all strategies work and have advantages and disadvantages. Like you articulated it nicely there with this Amazon stock. Past 10 years, it's done phenomenal, but at the same time, you're aware of the risk. If you were to isolate the past 10 years, you'd say, hey, this Amazon stock has kicked any life insurance policies butt, because it has when you look at the overall growth rate. But then to say, well, if I'm going to diversify and I want safe money that I just have peace of mind, I don't have to think about it, along with a tax benefit, that's where I can use the life insurance product for my real estate, just like you have been. So just spreading the risk, being diversified is really what you've done.
Exactly. Yep.
Yeah.
I mean, that's what it's all about at the end of the game, is like, as I'm trying to build this, what I call a runway of cash flowing assets, it's like managing risk and diversifying and managing the very precious resource of cash that can fuel that. So it's like, where can I get it? Either I'm generating it or borrowing it which then is used to get more income. So it's all about cash management at the end of the day. And having the policy is just one other way that you can manage your cash. And I keep going back because I'm a control guy. I always know, no matter what, I'm getting this money is there and it's protected. What I'm worried about, if we do or have a downturn, my asset-backed loan, my home equity line of credit, or I'm looking at doing a personal line of credit as well. These could be gone tomorrow. So I'm like, how do I take the money, put it into something that I can guarantee control and access to? And that's why I ended up getting more policies. It's like, once I started getting this, I'm like, this is my vehicle to drive my business forward. And then I started buying, so I ended up getting 3 more policies with, and then with you. And then now I'm just like, how do I put as much money as possible? It's almost so much every year that I'm like struggling to keep up with it. But I'm like, this is like it's a forced savings plan in a way to get me to generate enough cash so that I can get to my end goal, which is full-time real estate.
Got it. Yeah. And that too, you mentioned a good point where you've got that discipline, personal discipline to say, hey, I'm trying to force myself to get more money into it. But in the event that life happens, you said, hey, I can't get it in because the money's just not there. It's tied up in other areas. That's where I always like going back to the design. When you look at minimum premium policies and maximum PUA allocations, call it a 1090 split, that is a prime example of not only getting maximum cash value, but in the event that life happens, I can peel my payment back all the way down to 10% of what I'm used to paying in. And that's like, all right, I can do that, no problem. So we really just alleviate any chance of the policy feeling like a burden is what I found with a lot of people. But anyway, from a flexibility standpoint, it's nice to have that in the event that life happens. You say, I got to take my foot off the gas.
Exactly. Because like all my policies are 150 a year and they all land within 1 month.
Yeah.
And so it's like, how do you manage it? And at the end of the day, you're right. I roughly it's about 25 to 30,000 is the base that I have to do.
Mm-hmm.
And so like 150 is if I, do everything for the paid up addition. So I know that 25 is the minimum. I know that I'm making, at Amazon, I can cover that. The other thing is like, I can always use the cash value in the policies to pay the premium if I needed to in the short run to get me by before whether I sell a property or take the cash flow and pay it back. So it's pretty flexible. It's just, you need to understand the rules as you're getting going.
Yeah, definitely. Let's segue into the idea of policy loans and just the idea of a cash value collateral loan. Because when we last talked, when Phil and I had met with you, something kind of hit all of us just when we were talking, just with the idea of refinancing policy loans, where we've done it for years. And what kind of hit my mind is like, I saw your eyes light up. So I'm like, all right, if it's intriguing him, here we've got a guy who's really savvy with real estate. I know it's going to intrigue other people as well. So talking about it, I think would be beneficial. Is with your policies, you've borrowed directly against them, both with the Penn Mutual policies and also the Mass Mutual policies. And you've done well. The control factors there. But one of the concerns is with the older Penn policy, the direct recognition treatment's not bad, But just when you look at how Penn works is the first 10 years, when you take a loan against it, they still pay a dividend on the borrowed funds. However, it's a dividend of 4.35%, not the standard dividend rate, which is 5.75.
Mhm.
So you'll notice, hey, if I borrow and then pay it back, I've got less money than what I would have had if I just let it sit and grow. And you've got some larger loans outstanding. So what we discussed was the idea of, hey, you can take a life insurance policy with an outstanding loan balance to a bank or a lender. Those cash value collateral loans we always discuss, which is assigning the cash value as collateral to the bank. They'll give you a loan against the cash value. If you have an existing loan, call it $100,000, you can refi that. So basically what you're doing is you're saying, okay, I've got this outstanding loan with the insurance carrier, 100 grand at 5%. Now I can refi it at 3% with the institution. I pay 3% to them, but now it's a line of credit. I can pay it back wherever I want. It's a nice way to shrink the interest costs. And if you've got a direct recognition policy with the unfavorable dividend treatment or not as favorable as some others, it's a nice way to get rid of that as well.
Yeah, and that was like I heard about borrowing against the cash value, but this one, when you said it to me, I was like, oh man, this is a different angle on it that I hadn't thought about before. So, if I had, say, $100,000 loan where I'd already taken the money out, bought some real estate, right? So I've got to pay the bank policy back. And I think what you're saying is like, I could go to this other bank, borrow money from them to pay my insurance policy back, because generally I'm paying 5% on my policy loans. If I can borrow 3% or whatever from this other bank to pay that off, that arbitrage, if you will, a couple percent there is nice. And so I'm like, oh, any way you can lower your interest cost on this and keep the cash moving is a way to go. And I'm like, okay, I need to learn more about this, see how I can apply it.
Yeah, definitely. And in your case, I know one of the questions you had asked just as we kind of walked through it was, I'll use an example here. I'm going to just write it out as I talk, is if you've got, say, a total cash value of $200,000. That's what you're earning dividends and interest on. And you have a loan outstanding of $100,000, which means you've got available another $100K in equity, if you want to relate it to real estate, that you could borrow against of $100,000. So you're still earning dividends on the full $200,000. That's the beauty of cash value life insurance and why people are attracted to it, even though you've got the $100K outstanding. That $100K, if it's directly with the insurance carrier, I've got a cost to borrow, call it 5%, that goes to the insurance carrier. So if I were to refinance that policy loan with a bank, I say, okay, I want to get a cash value collateral loan. What that process would look like is I would say, hey, I've got this cash value policy. The total cash value, including the loan balance, is $200,000. I have a loan of $100K outstanding. So what they would do is say, okay, based on the $200K, here's a line of credit of $200K. Typically it's 95%, but let's just make it $200 for simplicity. $200K line of credit, of which $100K is already used up because we're going to refinance, call up the insurance carrier, and pay off the existing loan.
Mm-hmm.
So now you no longer have a loan when you look at your online portal with your life insurance carrier. Instead, it's on your online account with the bank that you just refinanced with, and it works like a line of credit, like any piece of property that you have. But it's a neat trick you can do. It's not really a trick, but it's a nice strategy you can do just to leverage money and put yourself in a better position.
Yeah, I love it.
Yeah.
Yeah, because it's less interest, and you're trying to optimize the cash that's in the policy.
Yeah, definitely. Well, I could talk about this stuff all day. Let's kind of segue into the last thing that we said we would talk about, which is your goal personally. So you're at Amazon right now, but your goal is to get into full-time real estate, correct?
Exactly. Yeah. My goal is by the end of 2022 is to have enough cash flow in real estate, and some active real estate from flipping and wholesaling, such that I can go full-time real estate.
Got it. Very nice. So with that goal in mind, when you hit full-time real estate, when that's your thing, Do you foresee yourself just going out and looking for deals personally and growing your own portfolio? Or do you want to be more involved in helping other people with coaching, having them potentially invest in properties with you and expanding it, making it a real business? Or do you like the personal play?
I'm going to do actually both. So
Nice.
I'm going to continue because I'm a control guy. I like to do a lot of most of my deals of the 32. I think probably like 25 are just 100% me. So I do have some partners. As I'm more full-time real estate, I'll continue to buy on my own, but I'm looking to get more whether it's equity partners or debt partners to continue to expand. At the same time, I love helping out other people. The only way I got here was going to other meetups, people who are farther ahead of me, giving me feedback and advice on how to get into the game. So I like to pay that forward. And then if there's an opportunity for us to work together, even better.
Yeah.
Getting to help somebody at the same time we're buying an investment property together. I love doing that. I've done that in the past. So definitely, if anybody who does want to reach out, like I'm on Instagram, JC Canberra is probably the best way to reach out to me.
We've got your contact info below too for everybody watching on YouTube. Let me ask this too. So thanks for mentioning that. So if that is something that you like to do and foresee yourself doing in the future, I talk to people quite a bit that are interested in getting involved in real estate. And I'm not an expert, or I don't have much knowledge at all in real estate. I'm not going to pretend like I do, other than just the commercial units I own here, but I'm not really involved in it. So if I wanted to get involved in real estate, my biggest fear would be I don't know what to do, so I'm probably going to mess it up and lose a lot of money as a result. So if I can talk to someone like you that says, okay, don't do that. Here's what you want to look for. Here's the questions to ask. Here's what to do. Is that something that you like doing and that you foresee yourself doing in the future?
Totally, yeah. I'm
Okay.
all about helping other people out on how to get in the game, and especially if because I invest in Seattle area, in Milwaukee, and Detroit area. So specifically on those areas, I'm well versed because I do deals in those areas. But in terms of general like investing in real estate, I love helping other people out. I mean, even at Amazon, I created a group here called Real Estate at Amazon. We have about 1,100 members, and I love just bringing in guest speakers, not just from external like industry experts, but also we do what's called an Amazon showcase where people like myself and others that are Amazon employees that have real estate to help get
Yeah.
others into this, financial independence and financial freedom aspect that real estate can provide.
Yeah, that's fantastic. The education is the most valuable thing. Well, thanks for going into that. Is there anything else you wanted to add before I just abruptly end?
No, I just want to say thanks for the opportunity. Behind the scenes, I've been watching tons of your YouTube content, and thanks for all the information you share. It's helped me really, understand better about these policies, and then the applications of them. And anytime you do ones about real estate, I love watching those ones as well. And so when we talked the other day, I was like, maybe I can help share that information about real estate and policies. So just want to say thank you for all the content that you're putting out there. Also, I love working with Phil. Phil helps me on all my policy questions and as I'm getting them set up. And I always say this way: your skills on operating that monitor that you have there in the office, I love it. The visibility that you give on the policies for people like me or others that are in tech or engineer or numbers based, showing the actual policies with the numbers and how it works out and comparing them. That's what's really gold on first why I actually ended up doing a policy with you guys. I'm like, this guy gets it. He understands all the policies. It's easy for him to explain it to me. And so thanks for all the content you put out there. It's helped me get more comfortable to get more policies and share it with other people. So I really appreciate that.
Sure thing. Now, thanks so much for the kind words. I appreciate that. And also just appreciate the feedback. Yeah, that's the biggest thing. And I get this from Jeff Bezos. Did you ever meet him, by the way?
No,
You never
no. We
got
have these like big town halls. I've seen him on
Yeah,
stage, but never
gotcha.
met him like one on one.
Gotcha. So I listened to him a lot, but there was an interview he had, I think it was with David Rupstein. I forget the guy's last name. But he just highlighted Amazon's number one focus is there's several principles of Amazon, but at the end of the day, we have an obsessive, compulsive focus on the customer. the customer, the customer, the customer. And that's what I always try and go back to say, okay, what are customers expressing, people we work with, what are they interested in, what do they not care about, and be laser focused on that with their content. And the feedback from you has been extremely helpful. So thank you for the ideas.
Hey, no problem.
Thank you. Well, thank you so much for your time, and everyone listening. If you would like to reach out to Justin or ever have questions on real estate and such, we've got his contact info below. And that's all we have today. Thank you so much for your time, Justin. I appreciate it.
All right. Thanks for the time.
Thank you. Enjoy. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.